Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to have you here. We are trying to help you improve your retirement. We do that by answering your questions. You can send them in. We are live right now here in Silicon Valley. You send them in. We'll try to answer them live also. So ask Tom at talkmoneywithtom.com, or you can put them into the chat. We'll be watching for both. We've already got some questions that come in during the week. We get questions that we, harvest really from some of our strategy sessions with our clients too. So good show today. Really looking forward to it. We believe that the more you know, the more you have in terms of your knowledge, you will have a better chance of having a better retirement. So we created this channel. You can subscribe to the channel, hit the bell button if you'd like to be able to get notified when we put new content out. We put out a daily video on what we see happening with the market. We put out lots of different, content pieces on a daily basis. So look forward to being able to help you with that. Of course, we can also meet with you one-on-one, either in the office or on the phone, video. Set up a time by going to our book appointment button on our website. Link to our websites here on the channel also. Our schedule is public, and you can pick a time that works for you, and we will get together and try to see if we can help you on a personal basis. So really fun. We love doing these shows. I'm hoping that you can get something good out of this that you can use kind of going forward. So feel free, start sending in those questions. We'd love to try to answer things that you have. There's a lot of things happening in the markets and the economy and the world right now. Try to get our opinion on some of those. Maybe that'll help you also. So look forward to that. I always like to start the show with a summary of kind of what we saw happening in the stock market this week, and really kind of I think this is important because a big chunk of what happens for retirement is your asset management, your ability for your assets to continue to grow, to keep up with inflation, make sure that it doesn't have, a big drop and those types of things. Retirement planning is another component, and then tax planning. We look at those kind of the big three. Mm-hmm. And so look at this S&P 500 chart. So this is the very beginning of this chart was the very high that we've had, all-time high at the beginning of 2022. Came down all year in 2022, basically, hit a low on October 13th of last year. And we've been riding up ever since, and really to the consternation of Wall Street for the most part. I mean, if you look at what has been going on in terms of the analyst projections, the economists, you look at all of the different articles and things that have been coming out, this wasn't supposed to happen.
Nope. We're supposed to be in recession by now.
Yep. Matter of fact, I would say the big consensus by the end of last year was that we were going to be maybe 20% below that low point that we hit in October. And so here we go. We continue to kind of get on the other side of that. And we've been pointing out, I think the pluses and minuses that have been happening in the economy all the way through. But, we had a checklist of things that we needed to see before we felt like we'd had a primary change of direction. All of those things were accomplished really back in May, early June, and we've had just a phenomenal run ever since. And one of the things that I think is important to understand about the market is you have to be really careful with kind of what you read out there and what you see. I get lots of articles from clients saying, oh, what do you think about this? And most of the times they're negative. Obviously, negative articles get more views than positive articles. Yep. And so there are a lot more of them out there, and something that's scary and the dollar's going to disappear or whatever it might be. I think one of the things that's important is to take a look at this chart. Mm-hmm. The thought process of that is that, it is in the price. That's kind of something I'm telling myself all the time, which just means that as I look at the price of the S&P 500, for example, here, it is telling us something, right? It is telling us that things could be decent here. We've now reversed fortune from a bear market, which is 20% or more down, to a bull market, which is 20% or more up. That's a really big deal. The shortest bull market we've ever had is 2 years, and we're really just kind of getting started with this. So there's some reasons why these things are happening and why things are getting better, and there's some risks, and let's talk about a few of those. So one of the things, and let me switch views here so we can see this a little bit better. One of the things that's happening right now is this artificial intelligence, piece.
Yeah.
Really, NVIDIA, who reports very late in the earnings season, kicked this off, and they had a fantastic report, a big jump in their stock price, and it really, everybody started looking around. So who else has that? Microsoft, Apple's getting involved with it, Google, and we're seeing, all of this artificial intelligence piece coming. So we're in what's called the hype cycle, which is this beginning piece. We saw this with the .com. We saw this with clean energy and those types of things. So there's kind of this perceived market opportunity there at the top. People can say, wow, this artificial intelligence can do all these great things. Here's how that's going to play out. And it really probably overprices things, because the next downward trend there is that facing reality. So eventually, at some point in time, this artificial intelligence piece is going to kind of face that reality. Some of these companies will fail. You see, get washed out. And then the actual reality comes in, and it actually often turns out to be higher. I mean, a great example out of the .com piece is Amazon. Yeah. And so we're in that hype cycle. Now, keep in mind that you can make great money in the hype cycle. You can have a pretty substantial run. I mean, I've forgotten where NVIDIA is now, but the last time I checked, it was up over 180% year to date, doing pretty decently. And so that's a pretty good hype cycle. But it is important to kind of understand where you're at. So we're not in the AI is going to go forever straight up cycle, in my opinion. And so, we want to watch that, and that's why we watch the price. We watch what's happening. So we watch the price of the S&P 500, like I showed already in the previous slide. Well, obviously things are going okay there, but if we see deterioration, we also watch the price in some of the artificial intelligence stocks and some of those ETFs that are in that arena. And we have a list of 175 ETFs that we use, and we can see things perking up to the top and then falling out of that top spot, and we rotate based on that. So I'd be a little careful to kind of buy in on AI permanently, because there's going to be some washout that happens here. But I actually think we're still early in this cycle. Yeah, in the hype cycle. So it's kind of a risk, but it's probably a good thing at the moment.
And the nice thing about AI too is it's a lot of mega cap big tech. It's not like these small startup companies. It's well-established companies. They're getting...
It really is, and they're the ones probably going to benefit from it also. I wouldn't be surprised to see a lot more small companies pop up, because that kind of happens, once things get going and what have you. We'll be reading about those. But again, to me, that also means we're kind of early in the cycle. That could have some legs here, could have some room to run. Inflation's the other big threat, of course. Especially a resurgence of inflation. It's kind of not really expected. Here is the CPI index for the last 3 years. This is the top line, includes everything, including food and energy. Well, this was reported, last week, in 2.97%. Pretty good.
Yeah.
Really, really nice. I mean, and that chart looks fantastic to me. It's actually looks like it's actually coming down slightly faster than it went up. It hit a peak of a little over 9% back in last June, so that's good. However, we are seeing kind of core consumer price not quite as good. Although I will say, if you look at the very last report here, that's a pretty nice little drop down.
Yeah, it finally broke through that kind of lull it was in.
It did, and hopefully that continues down. Although we're going to probably see some pressure on food prices with what's happening in Ukraine, with Russia going after the grain ships and those types of things, because wheat and grain is a big product out of Ukraine, and it's certainly a big product worldwide.
Yeah, we're already seeing a spike in the commodities market.
Yeah. It's been surprising to me that the Russia situation, the Ukraine situation, hasn't created more inflationary pressure. It has created some, but the very dire projections when it first started in February of 2022 haven't played out. Energy market and those types of things. So we'll see how this plays out. But you can kind of see here that core inflation, which is a more important component as far as the Federal Reserve is concerned, is still kind of hanging in there. Again, it's a little bit better right now, and so the market's reflecting that, but it's something to watch for as far as the risk goes. Now, what's the Fed going to do? Okay, I'm sorry you can't see this very well, but this is it's called the CME Fed Watch tool, and it's basically looking at the futures market for what's going to happen. The Federal Reserve meets next week. What are they going to do? Are they going to raise rates? They're not going to raise rates? Well, it's 99.8% bet right now. That's the highest I've seen, I think, that we're going to have a rate increase next week, right? Get another quarter point. But because the CPI numbers, the inflation numbers have been so good, we're starting to see a lot less anticipation of a second rate increase. They do have some time too, which I think is important because there's no meeting in August. They do go to Jackson Hole in Wyoming. They usually have some, I'll call it a speech that Chairman Powell might do. And then their next meeting is actually in September. I think that gives even more time for that inflationary pressure to maybe come down, or if it's going to come down.
The Fed to do a wait and see approach, which is nice.
Yeah, their projection was for 2 more rate increases this year. Market is saying 1 more, almost 100% chance it's going to be the next meeting, and really no other increase this year. Bernanke, the former Federal Reserve chairman, came out, yesterday, and said that he didn't feel like they'd probably have another increase for quite some time after this one. So that's good. I mean, because if we go back to this, direct correlation to lower inflation and a stock market that's going up. Yeah.
Yep.
I mean, so as long as that continues, this probably continues to hold up pretty well. So the next thing we want to look at here is just kind of all of this talk about recession. We have to keep in mind that employment as a whole is a lagging indicator. That's really important to understand. I keep getting clients talking about, how well things are going here, but this is really good, right? I mean, we're not seeing any cracks in the employment picture. Matter of fact, first-time unemployment claims that have every week were really lower than expected this week. The market kind of responded negatively to that.
Didn't like that.
Yeah, because, again, that's tight labor market creates higher inflation and what have you. But here's the number of people working. Well, we're back above where we were prior to the pandemic, which is fantastic because one of the tightest things that we have going on right here is this labor piece. We don't have enough people for the demands that are happening right now for this pent-up demand. Well, you can see it's steadily coming back, right? That's nice. Then we look at the unemployment rate. Wow, it's really low. This is going back to the 1950s. The last time it was this low was 1969. So really, really strong labor market. Creates some inflationary pressure potentially, but really creates some pressure to keep inflation away also.
Yep.
Recession away also. So, it's really hard for me to see a massive recession happening in the very short term here when you have so many people employed and you have so many job openings. Now, this is going back to 2000 here on the number of job openings. And you can see here that, obviously we've got a situation where it's slowing down. Now job openings coming down. But look at how high it is compared to where it was before. I mean, it's ridiculous how many jobs are open right now. Now, a lot of these are in the service area. Maybe they're not the highest paying jobs or what have you, but they're still there. And having them come down from that high that we set back there is actually, again, a good thing because this is going to take some of the inflationary pressure away. So it's a really, really good scenario so far. I mean, it really has played out well. The things that are slowing down, here's an analogy. You got 1,000 people lined up for your business outside the doors. Okay, great. You got a lot of pricing power. You can do a lot of things. Now you're down to 10 people lined up outside the doors. You're still busy. You're still doing business.
You may, but you just can't raise your price as much. And I think a lot of companies in their earnings reports are saying that we can't really push our profit margins any further. We kind of find that we're getting this. People aren't willing to pay the price anymore.
Yeah, and I think what's happening there, you're going to see some compression here of earnings because if you can't raise prices and some of your costs are still going up, labor costs and whatever it might be, in order to get the people to come to work, you should see some compression of earnings. That will create some issues for the stock market. And I've been talking this week about a period of consolidation where the market can kind of go sideways or come back a little bit or what have you. I think we're due for that. We just had such a strong run in such a short period of time. Here we are in earnings season, and I think that might be what causes that consolidation is some of those comments that are coming, whether that's happening right now in the second quarter that they're reporting on, or it's going to happen in the next quarter, when they give their forward guidance. So I think that's happening. So lastly, we're in a bull market. That's a big deal. And so the shortest bull market is 2 years. The average is 5 years. The average rate of return is 177%. We have a ways to go on this particular bull market potentially just to get to the average or even the shortest one. I think the shortest one was 50-60% rate of return.
Yeah.
So anyway, keep all these things in mind. I think it's really important to kind of have an idea of what's happening with the market and the economy right now. Things are still pretty good, but don't be surprised to see some softness coming up here just because we've had such a big run. We're in the middle of earnings season. They're going to raise rates next week, those types of things that I think are going to create some softness. But I think the basics are still there to kind of keep this rolling and keep it going. There's an awful lot of money that was sitting on the sidelines that missed out on a huge part of this run.
Yeah.
That's still coming in. So anyway, that's our summary for the week. Really appreciate you joining us for that. Look forward to being able to talk to you the next time. We will not actually be here next week. We will be here the week after. All right. So what's our first question?
How does the China slowdown affect the U.S. economy and the potential of a soft landing?
Yeah, so soft landing, just to define that, just means that, we don't have a really severe recession. Oftentimes a soft landing, you might have a recession on a technical basis, when they look back at it, but you might not really feel it, right? And both Yellen, the Treasury Secretary, and Chairman Bernanke, the Fed Chairman, have been saying we could have a soft landing going on here from the get-go. So far, and it's been over a year, they've been right. There's enough demand on one side to offset the things that they're slowing down, and we're in this middle. So what happens if China slows down dramatically? Does that push us out of this soft landing category into more of that hard landing, hard recession, higher unemployment, lower stock prices, those types of things? And so China's the second largest economy in the world. I consider there's two main threats, I think, to this particular run right now. Number one is a resurgence of inflation.
Yep.
Okay? And so we'll see what happens there. Hasn't happened yet. Number two is China falling apart, right? Because they're actually having deflation. They have high debt against property there, developers.
High unemployment in the youth.
Yeah, that's right. They've got a much higher unemployment. They've got an interesting situation that's totally different than what we're dealing with here, that's for sure. And so that's something to be aware of. I think longer term, there's a third threat of the Fed over-raising rates and maybe kicking us out of this soft landing into a hard landing recession. So, so far they've done okay there. But China, here's my opinion on China. It's worth watching, that's for sure. They've done some really strange things with their economy. However, politically, they're in a position where they can't really afford massive slowdowns because they've got the potential for sort of that uprising that can happen. So they had a little bit of an uprising about the COVID lockdowns, and whoop, they got rid of the lockdowns. And so they just announced recently that they're going to have some stimulus coming out to help support the economy, help support some of these property developers. I think politically that they have the capital and wherewithal to kind of bail themselves out, just like we did out of 2008, just like we did out of 2020. Matter of fact, China in 2008 was the one shining example of a country who didn't suffer that much, mainly because they did a lot of stimulus programs quite early, much earlier than we did, and kind of skated through. So I think politically there isn't a will to allow this economy, second largest economy, to fall apart. I think the government will continue to stand up and continue to do these things that need to be done. Is there a point in time where these governments can't do this? Yes, but it could be really far off.
Yeah.
We'll have to wait and see. But I mean, a great example is our own country here. Okay, we had Silicon Valley Bank goes out of business, and Signature Bank and First Republic Bank, and so the government steps up, sets up a facility so the banks can borrow against their bonds as if they were already matured at full value. They set up another facility to backstop some of the depositors in some of these banks, even above the 250,000. And that was the low point for this year.
Yep.
And then the market has taken off because, again, this is a government that is now figured out that we can do these types of stimulus programs and use the dollar as long as people are willing to lend us money. And so China's in that same spot. I think that China has that capability to avoid this. It's worth watching in case something happens there. Number one, they decide not to do the stimulus and let things fall apart. I don't think that happens, but it could. Or number two, they can't do the stimulus for some reason. There's some kind of illiquidity event that happens with their currency or something along those lines. I don't think either of those are very likely. I think it's much more likely they'll continue to kind of do the stimulus, do the bailouts, continue to take care of things as much as possible because they need to from a political standpoint, so they don't have kind of an uprising. Yeah, so it's a good question. I think that I think it's probably not as important as inflation as a whole in terms of the risk, because things are kind of softer here than they were, but still booming enough to create some more inflation. Yeah, so we'll see how that plays out.
What do we expect for next week's meeting with the Federal Reserve?
Next week's meeting with the Federal Reserve. Well, let's see. I can go back to our little chart here, which I think is kind of interesting, because this, again, it's a little hard to see, but this is the bet that the rates will stay the same in the futures market is that little number down there says 0.2%.
Yep.
Right. The bet that they will do a 1/4 point increase is this big blue bar is at 99.8%. So the market's been pretty right.
It's priced this in pretty much.
Oh yeah, yeah. I don't think it would be a surprise if they did 0.5%. Right, the market would react negatively to that. It would be a surprise if they did nothing. The market would react positively to that. But well, I think it's almost already cooked in here. There was an expectation by the Federal Reserve to make 2 more rate increases at the last meeting for this year. And after, if you remember the last meeting, they did nothing. They paused, right? But with CPI inflation coming down as much as it did, kind of surprisingly, to a large degree, I think that they do this rate increase and then they probably pause for the rest of the year unless there's just some strange reoccurrence of higher inflation. Inflation's been a little sticky, especially in the core area, but it's still slowly but surely coming down. I don't think they do another rate increase unless they have some excuse to do so.
Do you think during their comment or during Powell's probably at the end of the meeting, he always has his statements? Do you think he has something where they say we're going to have a second rate increase or something, they're going to kind of push down the market in a sense?
Yes, definitely. That's been a huge component of what they've tried to do all the way through here is use their words instead of actually raising rates sometimes to try to scare the market. So I would expect, that they would still say 2 rate increases. We're still expecting to do 2 for the rest, one more after that meeting that happens next week. And I would bet that you'll start to hear the Fed governors coming out. Whether they do it or not, we'll see. But I think they want to keep that rhetoric going. They want the market to have some type of fear that they might overraise rates, because when the stock market does what it's doing right now, for example, you end up with a situation where, people feel wealthier, and that's how you get this resurgence of inflation, is that scenario. So yeah, I would expect that definitely. I think there's only been one meeting, one time in the last year and a half where I felt like their wording was pretty soft. Otherwise, it's been very aggressive about what they're going to do, and that's partly what they're trying to accomplish is without raising rates, can we slow things down? Because raising rates costs the government money also.
Yeah, you have to pay for that somewhere.
Yeah. It's a good question.
What are some of the side effects of the NASDAQ special rebalancing of the QQQ or the NASDAQ 100 index?
Okay, so just to describe this, because it's kind of unusual, you were saying today when we were talking about this, they've done this. When was the last time they did this?
2011. So they've only done this twice since the index been around.
Twice, including this one?
Or this will be the third time.
This will be the third time, okay.
So it's 1998 and 2011.
All right, so pretty unusual. So what they're going to do is, so for example, Apple and Microsoft are both, a little bit more than 12% of the total of the top 100 stocks on the NASDAQ, what they call the NASDAQ 100. You can buy the NASDAQ 100 in an ETF called QQQ.
It's a pretty common investment that a lot of people tend to own.
We have it in our portfolio right now, for example. And so, what they're worried about is that we've had this run on some of these very large stocks, and the way that they make this index, it's based on the size of the company.
Mm-hmm.
So Apple and Microsoft, very similar size, and so they're obviously very large. And so if you look at all 100 companies and you look at the size of their company, what they call the capitalization, which is the number of shares times the price per share, they're at 12 point something percent each of this particular index. And they really want to try to knock that down. The rumor is maybe down to 4.5% range. And they also want to get the top 10 stocks down into kind of that 40% range of the total. Right now it's at 55%, something like that, right? So the impact is going to be that, there's a fair amount of money in these indexes. When they rebalance, they're going to be selling Microsoft, Nvidia, Apple, those types of things, and buying the other companies on that index that will be lower priced, that are below 4.5%, essentially, of that index. And so I think it's a negative for the markets as a whole, because all the markets are using the same capitalization thing. So when you hit the big companies, we will probably see some impact, and this happens on Monday.
Yeah, they're going to try and do this all before the pre-market, essentially.
Yeah, and I would suspect that this is also feeding into the thought process that I've been having about some type of a consolidation period here, where things, between earnings, the raising of interest rates, now this rebalancing of the NASDAQ 100, we get kind of a consolidation period within the market itself. Because, it'll be interesting because they're moving it. It's still in the index. The money's moving from one side to another, but the indexes are weighted, which just means that those big stocks, so if they sell off a lot of those big stocks, it's going to be a bigger hit to those indexes than you would have if they were buying those small stocks. So I think it's a negative. However, if you recall, at the end of each quarter, I'm always talking about the big rebalancing that these big funds do. Like I said last time, we had the end of June, we had that big fall, market's coming down. Everybody's kind of calling me, start sending emails and stuff. I'm like, okay, hang in there, wait until this finishes, and then boom, it takes off right after that.
Yep.
So what's that mean? And now, number one, it means it's not fundamental. It's not because there's economic issues or softness. If Apple and Microsoft are coming down, it's not because of their company. It's sort of this other structural issue. Mm-hmm. So it really becomes, I think, sort of a buying opportunity. And I think maybe that's what excites me about this whole consolidation period. You get some things that are cheaper. It gets people off the sidelines to come in and start to buy again. So if we can get through the pain of this and the period that we're about to probably go through here, I think it really kind of catalyzes a situation where we can get to a new level.
Yeah, and this is going to be a short-term effect. It's not a long-term structural thing.
Right.
Because in the 1998 and 2011, the market still ran afterwards. It wasn't like it really caused any kind of long-term downturn.
Right, exactly. Short-term pain, but could be actually beneficial and doesn't have any real long-term impact as far as that goes. Yeah, good summary.
Should I have different risk levels for different tax type accounts? So my Roth versus my IRA, or a traditional IRA versus my taxable account. Should I just have a different spread of allocations for those?
Okay, so let's just briefly touch on, you got taxable accounts, which just means that when you make changes, you have to put it on your tax return, dividends, interest, it ends up on tax return. You got tax deferred, which you can make changes, do all kinds of things. Nothing ends up on your tax return until you take it out. That ends up on your tax return. And then you got tax-free, which basically is tax-free. You can make changes. There's nothing ends up on your tax return. So you have these three buckets, and we talk about those three buckets all the time and trying to have money in all three of those buckets because there's pros and cons to all of them.
It's kind of like a stool. You want to have it in balance.
Yeah, it'd be nice to at least have three legs on a stool. That would be great. And so one of the things that you also can think about is, should I have different allocations for those different tax buckets, right? So you can make an argument to have more stock in a Roth because the Roth can grow tax-free, right? So long-term stocks outperform bonds, and so more stock gives you a chance to get more growth because there's no tax on it whatsoever.
Yep.
You could make an argument to have a bit more stock in your taxable accounts because there's a tax advantage, right? Because it's capital gains if you hold it for more than a year versus stocks in your tax-deferred IRAs, 401ks. When you pull that out, it comes out as ordinary income, which is higher, right? So capital gains rate can be 15 or 20%. You might be paying 22, 24% on your ordinary income, right? Something like that. And so that would be what we call asset location. And that is just, where you have your assets. The problem with that scenario is, if you think about it, you're going to end up with, let's say, a bit more stock in your taxable accounts, a bit more stock or a lot more stock in your Roth accounts. And if you still want to have an overall allocation that is still meets your needs in terms of how much, risk you're taking, you're going to end up with more bonds than you would normally have in your tax-deferred accounts. Mm-hmm. And that's assuming you have money in these three buckets. Yep. Okay, so that's a big assumption, because we don't see a good balance amongst those three buckets in general, right?
Yeah, it's a pretty heavy lean towards tax deferred.
It really is, because of people's 401ks plus the match, right? And the fact that the Roth is still being discovered, right? So it's not as many people are doing the Roth pieces yet. So essentially what happens here is we end up with a situation where you end up with kind of this weird account, in a tax deferred account, that's growing with only bonds in it, or a lot of bonds, or more bonds than you would normally have. And so I guess I'd be a little careful with that, because you don't really know what's going to happen. And one of the reasons to have money in all three, I would weight my Roth heavier in the stock market. Mm. And maybe I would underweight slightly to compensate that in my tax deferred accounts if I need it. So if I want it to be overall 60% stock and 40% bond, if I go to 80% or 100% stock in my Roth, I'm going to have to go someplace else and reduce my stock exposure. I would be that makes some sense to me. And those are also the easiest things to change. I might keep my taxable accounts right at 60-40 anyway, just because it's harder to change those when you get these big gains. But I could manipulate the risk level between my tax deferred and tax free accounts with no, taxable cost, right?
Yep.
So I could be, maybe a little less stock in my tax deferred accounts and more stock in my Roth accounts, overall still ending up at 60-40 potentially, if that's where my risk level is. And so, I could see that. That makes some sense to me. I love the tax-free growth is king in my world.
Yeah, and if you want to put your kind of your long shots or your home runs, that's where you kind of put those in their Roth accounts. That's where you want to have that kind of explosive growth.
Yeah.
That way you're getting that gain, and you can have more risk there.
Yeah. You gotta be careful going too far, right? Mm-hmm. Because, I'm going for 15-20% and end up with negative 15 and 20, and then I keep messing up, and I'm never going to get that tax-free growth. Whereas if I had just stuck with the market itself and done a 60-40, I might have made 8 or 9 or 10 or something, or 7 or whatever it is, And so, at least there's something there. So I'd probably combine that. I might have some home run pieces in there, but I'd keep it, to a smaller portion of the portfolio.
Maybe like a 1 to 2 kind of percent.
Well, I might go 5 to 10 to 20%, depending on, what I'm dealing with. I don't have a problem with that. If you had 80% in traditional ETFs, market mixture, at whatever rate that you're at, 80-20 or something, and then the other 20% was in some individual stocks, I could see that. But it depends. It depends on what risk you're willing to take. Depends on your age. Depends on how much you're going to need that money, how long you could let that money sit there. So it's a bunch of pieces to figure that out. And maybe it is just 1% or 2%, depending on the situation. But yeah.
So you talked about a consolidation period earlier. What would that period look like? What could we expect from the market?
So consolidation period is, let me share the screen here. So you can see I basically highlighted more or less May that happened here in the U.S. And so we had a nice run up from that low that we're looking at before those red lines there that touched that trend line was actually when Silicon Valley Bank went out of business. So it's kind of, again, exactly the opposite. This is the point in time when everybody thought everything was going to fall apart, and it turned into be the point in time that everything took off, because the government changed the direction, right? So you always got to be aware of that in today's world. But we had that jump, and then we had this consolidation period. Some of that was really revolving around the debt ceiling debate that was happening. If you remember, June 5th was the drop dead date, and so that's all markets kind of hanging in there. But one of the things that happens in consolidation periods is that a lot of shares are purchased at the same price. So if you can break above that, that becomes support. And so that is a nice support zone right now. But we haven't had one for a while. You can see we've had quite a nice run here without really any significant consolidation period. And I just feel like we're kind of stretched out. Mm-hmm. All right? And so we should see something here happening. But that's what a consolidation period is just kind of, sideways motion in a range. Essentially the market's just kind of taking a breather, letting earnings catch up or letting things catch up or what have you.
Yeah, and usually when it breaks out, it is a stronger movement up or down. Yeah. So it's tends to be when you have these periods, you then see the big swings up or down.
Yeah, that's exactly right. So that's a big deal, and that's an important understanding. We don't have to have a consolidation period here. I will say, sometimes the market just gets hot and really hot. I think we're kind of due for something like that in the sense that, things are doing better than expected. Wall Street's had such low expectations coming into all of this year that, a lot of people are caught on the wrong side and they're reversing that. Hedge funds moving out of short positions and, all those things. So I do think that there's some, room to run here, but it's had a good run. I wouldn't be surprised to see some consolidation.
What are my options if I don't have enough liquid funds for retirement? Majority of my wealth is locked up in my home.
Oh, okay. That's not uncommon here, right? I mean, people bought a house here between, 60,000 to 350,000. Some of our older clients that is now worth, $1.5 million to $5 million. I mean, there's the crazy things that's happened here in the Valley. And so if by chance you haven't had success in saving other assets, which it sounds like in this question you haven't, and your money's in your house, and now you got this $1 million, $2 million, $3 million equity in this home, and you're sitting on, let's just say, $100,000 of savings, which really isn't enough, mm-hmm. right, to retire on potentially. You only have a couple of options. You either, decide to stay and keep everything as is, live off Social Security, live off that 100,000, reduce your standard of living a bit. We have people that have done that over time, and they do okay with that.
Yeah.
It's hard. I mean, your house has a drag of money as it gets older too. Mm-hmm. It needs to be repainted and all those type of things that happen. But another option is to sell the home and move to a cheaper place. Mm-hmm. The pros and cons to that: you got to pay taxes. You actually got to move, yep. which a lot of people don't want to do. It's really hard to move. There maybe is some emotional attachment to the home also. Where you raise your family or what have you. However, that's a way to spring out a whole bunch of money. Maybe, move to another place, buy something with cash. Even after you pay your taxes, still end up with a whole bunch of money. Yep. Now you got a lot of liquidity. You went from $100,000 to $1 million of liquidity or whatever it might be after you got your new place. And you have that start to produce some income for you so you can enjoy your retirement. And so, we have clients all over California and all over the U.S. because they've moved out of this area and kind of captured that. A lot of people stayed, but we have a lot of people that have moved.
Yeah, you could stay for a portion of your retirement and then move. You don't have to actually move immediately. So you could kind of do a long-term planning of this. You could go visit other locations. And then if you really want to stay, there's the option of reverse mortgage.
Yep.
It's not, I would say it's kind of an expensive option because you're basically you're getting payments and then they're charging an interest rate, and then at the end of your life they'll sell the home, and then they'll basically give the net proceeds to your beneficiaries.
Yeah, it's a reverse mortgage. So instead of you paying the mortgage payment, they're paying you every month, and it's increasing your mortgage.
Yeah.
In essence. And those used to be really bad. They've gotten better through regulation and what have you. And it is an option. It's something. And there's some advantages to it in that you don't have to move, right? If you really like where you are, if you have sentimental attachment, you also don't have to pay the capital gains tax on your house by selling it. That's kind of nice. If you hold on to it until you pass away, your beneficiaries would get a step up in basis, which just means if your house, you paid, $100,000 for a house that's worth $2 million, it would now be stepped up to a basis of $2 million. So if your beneficiaries had to sell it, there'd be no gain at that point in time. So there's some advantages to a reverse mortgage to allow you to stay. Again, maybe not the best solution, but again, all of these things have pros and cons that are worth looking at as far as that goes. So yeah, it's a good question. It comes up. It's a good problem to have. Not every place in the country has had this type of appreciation, out of their real estate, and not every one of our clients has had that kind of appreciation even here if they bought later, but it is something we see quite often as far as that goes. So, all right, well, that's going to be it for today's show. I think we've got a really good show today, really good questions today. I enjoyed this a lot. We will not be here next Friday. Just again, clarify that. We will be here in 2 weeks, and we'll get this rolling again. And so feel free to send in your questions now, so we got a chance to take a look at them. Here's the email address, asktom@talkmoneywithtom.com. Be happy to kind of answer those in a couple weeks. You can obviously subscribe to the channel, hit the bell button and get notified when we put something new in there. And that helps us too, which is great. We're always looking for new subscribers. And then lastly, of course, you can book an appointment with us if you'd like. You can, set up a time to talk to Eason and I. We can show you, specifically in your situation, how we might be able to help you. So look forward again to being able to see you in a couple weeks. And thank you so much for joining us today. And we'll see you then.